On April 7th at 5:32 p.m., Donald Trump announced a ceasefire with Iran, and that single announcement taught us two things. First, that Truth Social is apparently the greatest invention of our generation and definitely not just another social media app nobody needed. And second, that markets absolutely hate uncertainty, because the very next day they exploded. The S&P closed up 2.5%, the Nasdaq nearly 3%, and the Dow shot up more than 1,300 points, its best single day in almost a year. But it didn't stop there. A few weeks later, stocks were sitting at record highs again, even while the ceasefire itself was quietly falling apart in real time. The mainstream financial press called it a relief rally. Markets celebrating peace breaking out. Except that's not actually what happened. It was something else entirely. And to understand what that something else really was and how markets can hit all-time highs while a war is still going on, you need to rewind and look at what was happening on Wall Street before any of this started. Because there's a much bigger story buried underneath that relief rally headline. On February 28th, the U.S. and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was killed. Iran responded by shutting down the Strait of Hormuz, and markets went into their worst 5-week losing streak in nearly 4 years. By the end of March, the S&P had dropped almost 9%. And while everyone's retirement account was quietly bleeding out, something bigger was happening underneath the surface. Wall Street was starting to panic. Hedge funds weren't just trimming positions, they were dumping stock at the fastest pace in 13 years. And that's not a rough guess. That's documented. Goldman Sachs had a front-row seat to the whole thing. Since they run a prime brokerage desk that services most of the major hedge funds, meaning they can literally see what these funds are buying, selling, and how leveraged they are. According to Goldman's own numbers, Q1 hedge fund selling in North America was the heaviest since April 2020. Gross leverage was sitting above 300%, near an all-time high. And short exposure on macro ETFs like SPY and QQ hit levels not seen since the pandemic. Then, on March 19th, commodity analyst Rory Johnston put it like this. If you think about some kind of massive detonation in the oil market supply chain in the Middle East, and there's this shockwave that's moving out, this shock is too large for the system to handle. And it will begin to creak and break the longer this goes on. When asked just how big the disruption was compared to the 2008 squeeze, he didn't hold back. It's bigger than anything in history. Every analyst I speak with, people I respect, people who aren't alarmist, people who make fun of the alarmists, they're all terrified. Let's say the East-West pipeline is maxed, there are no issues at Yanbu, the Houthis don't get involved, etc. Even in that scenario, with the strait remaining closed, we'd still need to shed 15 million barrels a day of global demand. And that just means prices hitting $250, $300 a barrel of Brent. We'd hit all-time highs on an inflation-adjusted basis, almost guaranteed, almost by necessity. So in that scenario, recession is too light a word. We're talking depression. Fast forward 6 weeks, and here's maybe the funniest part of this whole story, but at that point the mood on the street was simple. Everyone was bearish. Then, on the evening of April 7th, Trump announced the ceasefire. When markets opened the next morning, it was like someone had flipped Jerome Powell's money printer back on. Over 400 names in the S&P closed grain, 13 stocks hit all-time highs, Brent crude fell around 13.5%, and WTI dropped more than 16%, the biggest single-day decline since April 2020. But here's where the world is at peace story starts falling apart. According to maritime intelligence firm Windward, which uses AI to cross-reference GPS signals with satellite radar and imagery, only 5 outbound tankers were actually detected moving through the strait by midday. That's roughly a 96% drop in activity compared to the pre-war baseline of around 130 daily transits through the Strait of Hormuz. So something doesn't add up. How do you get a relief rally over world peace when there's no actual peace happening? Which brings up the real question. What actually moved the markets? And the answer is a good old-fashioned short squeeze. I can prove it too, but first you need to understand how a short squeeze actually works. When you short a stock, you borrow shares from someone and sell them, betting the price drops so you can buy them back cheaper later, return them, and pocket the difference. But if the price goes up instead, you're in trouble. Because you still owe those borrowed shares, and now you have to buy them back at a higher price than you sold them for. The longer the price keeps climbing, the bigger your losses get. Eventually, your broker can hit you with a margin call, meaning you either put more money into your account or close the position immediately. And when a lot of people get margin calls at the same time, they're all forced to buy back their shares at once. That wave of buying pushes prices even higher, which triggers more margin calls, which triggers more buying. That's a short squeeze. And on April 8th, with macro short exposure sitting at its highest level since 2020, the squeeze kicked off. But the squeeze was just the first domino. Once stocks started ripping higher, the algorithms took over, and that's where CTAs, commodity trading advisors, come into the picture. These are systematic trading firms running on rules-based models. They don't care about headlines or geopolitics, they just follow the trend. When the trend points down, the algorithm says short. When it points up, the algorithm says go long. It's purely mechanical. Goldman reported that CTAs were sitting on roughly $30 billion in net short positions heading into the ceasefire. But the moment the S&P crossed certain trigger levels, those models flipped. And they didn't flip to neutral, they flipped straight to long. Goldman initially estimated CTAs would need to buy back around $40 billion in equities to close out their shorts. The real number ended up being $86 billion across just 5 trading sessions, which, according to Goldman's own records, ranks as one of the top 5 fastest buying sprees ever recorded. Then came the third domino, the options market. Dealers on the other side of options trades have to stay delta neutral, which means when customers pile into call options, dealers hedge by buying the underlying stock. Spot Gamma, a leading financial data platform, had flagged a negative gamma regime heading into the ceasefire, the kind of setup where dealer hedging flips from stabilizing the market to actively amplifying its moves. Price goes up, dealers buy more, price goes up even more. You get the idea. So you had a squeeze, plus a systematic algorithmic flip, plus dealer hedging, 3 dominoes falling one after another. That's the rally. That's what actually happened. And here's the funny part. This isn't the first time we've watched this exact movie play out. It's the same pattern that's repeated again and again over the last decade. Go back to December 2018. Stocks had been crashing for months on fears of a rate hike. Then Jerome Powell walked on stage, said one word, patient, and the Dow exploded, gaining more than 1,000 points in a single session for the first time ever. Or look at August 2024, when the Bank of Japan raised rates for the first time in 17 years. The yen carry trade started unwinding, something I've covered in another video. And the Nikkei dropped 12% in a day before bouncing back 10% the next. Different triggers every time, but the exact same mechanism underneath. The reason this keeps happening is that the structure of the stock market itself has fundamentally changed. 20 years ago, the market was driven by humans, portfolio managers reading earnings reports, analysts modeling out cash flows. Real people making judgment calls about what companies were actually worth. That market is basically gone now. Today, 63% of all U.S. stock funds are held by passive index funds, more than $13 trillion of money that doesn't read a single earnings report or care whether Apple had a good quarter. It just tracks the index on autopilot. And because most passive funds are market cap weighted, the bigger a company gets, the more of it they're forced to buy. Which is exactly how the Magnificent Seven now make up over 33% of the entire S&P 500. So a massive chunk of the market isn't really being priced anymore, it's just getting allocated by default. And what's left of active investing has changed too. The hedge fund industry has consolidated into a handful of giant multi-strategy funds that now dominate everything. The Millenniums, the Citadels, the .72s of the world, and their assets under management have exploded over the past decade. These funds typically run at 4 to 8 times leverage with strict drawdown limits, which means when they hit that limit, they don't sit around debating whether the Fed will cut rates or whether the war is actually over. They sell immediately. And underneath all of that sits the options market. Same-day expiration options now make up around 63% of all S&P trading, and on the busiest days, over $2 trillion in notional value changes hands in a single session. Every one of those options forces a dealer on the other side to hedge in real time, buying or selling the underlying stock to keep their books balanced. So the dominant forces in the market today aren't analyzing valuations or fundamentals at all, they're just reacting. And when price moves, all those reactions stack on top of each other. That's exactly what happened on April 8th. Once you understand the mechanics behind it, once you see why markets behave so irrationally, it all starts to make a lot more sense. So if you're tired of traditional financial media feeding you the watered-down version of what's actually happening in the markets, hit subscribe, because this is exactly the stuff they conveniently leave out. The stock market we all grew up hearing about, the one built around finding undervalued companies and holding them for the long run, that market is gone. What's left now is one giant feedback loop of algorithms, passive funds, and options dealers all reacting to each other in real time. And the headlines? Those are just the stories people tell themselves afterward to make sense of it all.